The position is down. Not by much, but it's moving against you. And your first instinct isn't to exit, it's to think. The thesis is still valid. The setup still makes sense. If this was a good trade at the entry price, it's an even better trade at this lower price. The market is giving you a discount. So you add. If that sequence of thinking is familiar, this video is going to show you exactly why it feels completely logical and why it is one of the most dangerous patterns in trading. The averaging down trap is unique among trading psychology patterns because it is the only one that actively feels like good decision-making while it is happening. Every other pattern we have discussed, the escape route bias, the house money trap, the reset illusion, those feel uncomfortable. You know on some level that something is wrong. Averaging down feels smart. It feels disciplined. It feels like you are thinking clearly while everyone else is panicking. That is what makes it so dangerous. Here is what averaging down actually does to your position, not emotionally, mathematically. When you add to a losing position, you are increasing your exposure to a trade that the market is already telling you is wrong. Your original thesis said price would move in a specific direction. Price moved the opposite direction. The market has responded to your thesis and disagreed with it. Adding to the position does not change the market's response. It doubles your commitment to a thesis the market has already challenged, and it dramatically increases the size of the loss if the market continues to disagree. A position that was risking 1 unit of capital is now risking 2, 3, 4, depending on how many times you add. The loss that was manageable at the original size becomes account-threatening at double or triple size. There is a second layer to this trap that most traders never examine. When you average down, your break-even price moves. The position now needs to recover further before it shows a profit, which means you need the market to move more in your favor than your original thesis required. So you have taken a trade that was already not working. You have increased the size, and you have raised the bar for what it needs to do to be profitable. Every single variable in that equation has moved against you, and it still feels like the right thing to do. Let me show you exactly how this plays out in a real trading session. A trader enters a position. Valid setup, correct size, stop placed correctly below a key level. Price moves against them. Not to the stop, just uncomfortable. The thesis still feels valid. They tell themselves, this is just noise. The move I identified is still coming. If anything, this is a better entry. They add to the position. Size doubles. Stop gets mentally moved lower because the original stop no longer makes sense at the new average price. Price continues lower. Now they are down significantly on a double-sized position. The thesis still feels valid. They add again. The position is now triple the original size. The loss is approaching the kind of number that changes how they trade for the rest of the week. The stop, if they even have one anymore, is so far away that hitting it would be catastrophic. And somewhere in that moment, the thesis stops feeling valid. The market has been disagreeing with it for too long. But exiting now means locking in a loss that is many times larger than the original planned risk. So they hold and hope and the trade that started as a structured, planned position has become a prayer. Now here is the question that exposes the core of this trap. If the thesis is still valid, why did you move your stop? Your original stop was placed at the level where the thesis would be invalidated. If price reached that level, the thesis was wrong. That was the plan. Averaging down is almost always accompanied by stop removal or stop movement. And that combination, adding size while removing the risk limit, is the exact sequence that turns losing trades into account-ending ones. What do traders who have broken this pattern do differently? First, they treat the original stop as a thesis invalidation point, not a loss limit, not a pain tolerance level, a thesis invalidation point. If price reaches that level, the thesis was wrong. Full stop. Exit the trade. Do not add to it. This reframe is important. A stop is not the market taking money from you. It is the market telling you that your read on the situation was incorrect. Accepting that information and exiting is not weakness. It is correct processing of market data. Second, they implement a no-add rule for losing positions. Simple and absolute. If a position is in the red, no additional size. Ever. Under any circumstances. The only decision available is hold or exit. Never add. This rule eliminates the averaging down trap entirely. There is no decision to make. The rule has already made it. Third, they separate the concept of a good thesis from a good trade. A thesis can be correct, and the trade can still be wrong. If you entered at the wrong time, the wrong level, or the wrong size, that is a trade management problem, not a thesis problem. Averaging down does not fix trade management problems. It amplifies them. One more thing before we close. There is a version of adding to positions that is not averaging down. Scaling into a position as it moves in your favor. Adding as the trade proves itself correct is a legitimate approach used by experienced traders. The distinction is critical. Adding to a winning position that is confirming your thesis is structurally sound. Adding to a losing position that is contradicting your thesis is the averaging down trap. One adds size when the market agrees with you. The other adds size when the market disagrees with you. They feel similar in the moment. They have completely opposite outcomes over time. This video is for educational purposes only. Nothing here constitutes financial advice. Trading involves substantial risk and is not suitable for everyone. The question I want you to sit with: when you average down, are you responding to new market information? Or are you responding to the size of your loss? Be honest with that answer. It will tell you everything you need to know about whether what you are doing is strategy or emotion. Drop your answer in the comments. And if you have not seen the first 3 videos in this series, watch those next. These 4 patterns together explain the majority of why disciplined traders still lose money consistently.